All right, yeah, maybe Jason will join us in a few minutes. But yeah, I'm Casey Wagner. I am a senior reporter at Blockworks. We'll talking about decentralized liquidity. I wanted to start with an introduction. Amir, if you can hear us, I would love for you to start.
All right, awesome. Yeah, I'm Amir, co-founder, co-CEO at ZeroX Labs. We are building decentralized exchange infrastructure across all layers of the stack. Our two most popular products are ZeroX API, which is a liquidity aggregation API live on 7 different blockchains right now, as well as Matcha, which is a user-facing decentralized exchange aggregator.
Hi everyone, my name is Nikita. I'm Chief Business Development Officer at 1inch, also the first employee. And a quick introduction on 1inch, we are a DeFi aggregator, one point of entry into DeFi. And I hope you've tried our product before. If not, we try to give the best rates and the best user experience to community. So go ahead and launch our app.
Yeah, hi everyone, my name is Andrea. I'm the partnership lead of Balancer DAO. Probably most of you know Balancer. You guys also know that Balancer at the moment is not present on Avalanche. But here I am to share with you my knowledge and what I've learned so far. So thank you.
Great. So I wanted to start with talking about what are the major sources of liquidity today and who's really participating in the market. Amir, if you want to start again.
Yeah, so I think it depends, what stage of a token's life cycle we're talking about. For brand new tokens, typically I think there is a lot of retail involvement. You'll see a lot of liquidity in fairly basic automated market makers, Uniswap V2 style market makers, or perhaps some of the higher fee pools for some of the more sophisticated market makers like Uniswap V3. But as time goes on, markets become more liquid and more bootstrapped, and there's more trading activity. We've seen more like institutional, professional participation on the liquidity side. So yeah, typically, more professionals will enter the space and will converge on like lower fee AMMs or models like request for quote, which are plugged into like ZeroX API, for example. And market makers are able to provide really competitive pricing through these models and have a number of benefits for users as well, like zero slippage, zero MEV, and yeah, they're able to do this as markets are bootstrapped because they have access to more hedging instruments and hedging venues.
Yeah, well, since 1inch started as a hackathon project, originally we aggregated liquidity from decentralized exchanges. We started with Kyber Network, Bancor, Uniswap, and originally, our users and our focus were retail investors and projects like that are in DeFi. And then after the DeFi summer, when everything exploded and we saw a lot of institutional players incoming, the competition from traditional market makers intensified, and they primarily use RFQ models RFQ orders to be plugged into the DeFi infrastructure. And it creates very interesting tensions and helped to push market further. And we have now a lot more competitive rates, and which always benefits, the end user, retail traders. And we have this interesting shift which moves towards institutional clients and institutional investors and market participants in general. So yeah, we have a good mixture of both on the market right now in terms of liquidity. So yeah, can't wait what happens when algorithm and the trading becomes even more efficient, when fees go lower, and we'll see a DeFi Summer 2.0.
Okay, very interesting. Well, what I can tell about Balancer in terms of market efficiency is that now we have a new product which is called boosted pools. Basically, boosted pools are a new product that we launched less than 2 months ago. and basically use those pools. They use those funds, those assets that are on those pools that we have, and lend them to lending protocols like, for example, Aave, etc. So we increase basically the efficiency of all those assets that usually are parked there, and now by using this new technology, we're able to lend those assets away. So we increase this kind of, a little bit of the efficiency there. So yeah.
Yeah, definitely. Amir, you touched on this a little bit. In terms of market participation, are we seeing more interest on the retail side or the institutional side? And then also, how do their liquidity needs differ?
Yeah, again, I think it depends a little bit, like, the level of volatility of the token and such. But I think it seems to be converging more on the institutional side to me overall. And institutions they're looking for volume. There needs to be trading activity in order for them to be profitable, and they're looking for capital efficiency for the most part. And RFQ is about the most capital efficient you could possibly get. So if you have $1 million in your wallet, you can make a $1 million trade. And there potentially will be ways to incorporate leverage and similar things down the line. But I also want to just say, like, the liquidity space is all very complex. They're literally in the hundreds of decentralized exchanges out there, and I think that's just why aggregation is so important. Like, for end users, just should not have to think about any of this. They shouldn't need to understand what RFQ is, or what balancer is, or Uniswap, or anything, right? Like, they just want to use an aggregator, not think about it, and get the best price.
I think there are currently some obstacles that prevent, mass adoption and retail like going big. Things like impermanent loss and UI of majority of platforms is still not super efficient. Plus, currently what we see projects with high TVL like Curve or Sushi, they rely heavily on farming programs and different incentives. And we need to figure out ways how to, help liquidity providers earn more without increasing fees that they earn, or without like airdropping governance tokens and bootstrapping this artificial capital or mercenary capital. At OneInch, we had this case when we launched our own AMM, and we started a farming program, and in January 2021, we had over $2 billion of liquidity, and when we stopped it, the TVL dropped by 90% within like 1 week. So we need to find out how to, in the long run, benefit LPs and people who provide, capital to smart contracts and make the whole system work. And this is what Balancer does really great with the bootstrapping pools. Yeah.
Yeah. It's a good question to try to figure it out, how this market can evolve from the current state, which is mainly, retail-driven, to a more institutional grade, let's say, market. The problem that we don't really know what is the path ahead. What we know is what has been working so far. So we went basically from just a few tens of millions of dollars in TVL to over 200 billions in less than 2 years. And what we know today is that basically liquidity mining has been, while I understand that there are a lot of there's a lot of critics around this model, at the same time, it's a very powerful tool that we used to attract a lot of liquidity. Now that the question that we have now is how we're going to go from those 200 billions to 1 trillion, which is the next question. And if you ask me, personally, I don't have an answer. But we certainly know what are the tools that have been worked so far. Yeah.
And then just in terms of onboarding institutional users, what hesitancies do they have? What concerns do they have?
It's another very good question. I think at the moment regulation is one of the biggest problems. Okay, so we are still generally the market is very much America-centric. So we're pretty much waiting for the American government, the U.S. government, to come out with some regulation that will help, ease a little bit of concerns from all these institutions. So that's the main blocker that we see for this further expansion in liquidity. And then, of course, if you go on a retail level, probably the knowledge, the understanding on how this system works still needs a little bit of help, to facilitate the normal user to come on board.
At OneInch we spoke with majority of the big traditional finance players, and they all want to tap into DeFi, into crypto. Some of the biggest names from Wall Street want to be a part of the system, want to contribute and be involved into farming. They see how the market is evolving and that it's becoming more transparent and efficient. However, due lack of KYC, AML mechanism and protections, they just can't. And yeah, everyone is waiting for the regulations to be worked out by US and the other governments as well. So this is the obstacle. I see that the permissioned DeFi is evolving. We now have Aave Arc deployed with Fireblocks, and it's a good playground for all those companies to feel what crypto and DeFi in particular feels like, and maybe eventually they'll be able to do it on permissionless level.
Amir, did you have any thoughts?
Yeah, I actually think the main blocker is just getting more users and more trading activity in the space. From my experience, market makers and liquidity will follow that if the opportunity is large enough. And I think liquidity infrastructure is good enough at this point where, for the most part, you don't actually need incentives. I think if you want to attract retail liquidity providers, you probably do need some sort of incentives in the early stages. But we saw the Ape token launch about a week ago, and it probably has over $50 million in liquidity. And to my knowledge, that's not being incentivized. So I think we'll see a lot more of that for in demand and popular tokens.
Yeah, definitely. I wanted to ask about capital efficiency. It seems like most of the lending in this space is still very over-collateralized. Who are the borrowers going to be? Amir, if you wanted to start again.
Yeah, that's a good question. Definitely a lot of institutions and market makers. But overall, I would say if you are seriously managing a portfolio of any kind, even if you're not a professional market maker or anything, you're probably leaving money on the table if you're not lending out your assets and then borrowing against them or something like that. I think people overstate the downsides of over-collateralized lending generally, and from my experience, it's kind of a light bulb moment once you do it for the first time and you realize that it's actually more useful than it sounds. But with over-collateralized lending, you can trade with leverage, you can go short, you could borrow against your assets and use them to generate yield. Anything along those lines, it actually ends up being pretty useful.
Yeah, from parties we worked with, it feels like market makers, definitely a major group that is involved into borrowing and lending, and they need access to those new tokens, and they have their own benchmarks. They know how to play this game, and they need access to long tail of assets or some assets that are just being issued, and if they're not already in the system in like platforms like Compound or Aave, it's very hard for them. They have to reach out the protocols directly. And there is a big interest from them and from parties who are heavily involved into DeFi yield farming, different protocols, that know how to optimize for yield gain. And so those two groups come into mind, and that's it. It's a big question how we can scale it and bring more users who would benefit from borrowing those assets.
Yeah, it's a very good, important question, and What I can tell is probably that leverage farming is probably the main, the main role that lending platforms are used today. So as far as your borrowing expenses are lower than the yield farming that you can produce from those assets, then of course you increase efficiency. Now, for the over-collateralized, then that's another story, and probably that's a little bit of the nature at the moment of the market. Yeah.
I wanted to shift gears a little bit and ask about decentralized exchanges. Are DEXs looking to kind of replicate the centralized exchange model, or are there different goals? Whoever wants to start.
So you want me to say? Oh.
Sorry. Amir, yes, please.
I think in the long run, DEXs are kind of a superset of centralized exchanges, probably for the most part. You'll be able to do anything you can do on a centralized exchange, but there are just also going to be a lot of use cases and assets that don't necessarily make sense to be traded on a centralized exchange. I think non-fungible tokens are a good example of that, where I would consider trading NFTs also, a form of decentralized exchange. And we haven't really seen a ton of activity on the NFT centralized exchange counterparts yet. And I don't know if we ever will. But I think in the long run, people are just going to use decentralized exchanges a lot more as a byproduct of more applications becoming tokenized. Trading might not be the first major use case. People aren't sitting down and day trading necessarily, but it's more that they're using these applications and then they just end up having to make a trade at some point in the flow. Where centralized exchanges are pretty specifically for the trading use case. It's less of a tool. But that being said, I think that centralized exchanges still probably will be pretty important as fiat on-ramps and off-ramps down the line.
Yeah, I mean, is right. The centralized exchanges, the main role that probably the competitive advantage that they have is the on and off ramp functionalities. But apart from that, decentralized exchanges in general, they have another set of advantages. Number one is lack of KYC, for example, very important. And number two, you don't have this gatekeeping that probably centralized exchanges have. So basically, any user has the possibility to invest in any possible token. So we don't really I don't really see a competition in that perspective compared to centralized exchanges. When it comes to Balancer, though, we don't really want to be or seen as a DEX, really. We want to be like a building block on top of which other protocols and other projects that can build, other things can build on top of us. So we are a little bit different from the typical, Trader Joe or the Uniswap guys out there. So.
Also, a small minor point that it feels like AMMs is a prime form of DEXs, and it will remain that way on all EVM-compatible chains. Even platforms that are trying to, use RFQs, they still have formulas behind them, and they need to calculate for many parameters. So I don't see order books coming into crypto, and yeah, that's just one small point.
And then in terms of aggregation, where will value be captured most? Is this going to happen on the DEX level or where?
Oh, that is a fantastic question. There are so many theories about it. Some people believe, wallets as an initial point of entry, and platforms like MetaMask with MetaMask swaps will be the ultimate, entry point into crypto, and they might be right. Aggregators, yeah, they are a bit above DEXs because we can touch into various liquidity pools and not necessarily to AMMs, but into, platforms like Aave, for example, for liquidations and for other types of liquidity. Certainly, there is, due to superior algorithms, it's possible that this level will capture a lot of, traction, money, attention, and user base. But currently, you know, if we look at 1inch, for example, between around 70% of volume that went through our smart contracts went to Uniswap version 3 during the last months. So, you know, DEX space is heavily concentrated in the hands of Uniswap right now. And if for some reason there is a superior DEX that, you know, absorbs even more, let's say in like 90% of the market, then DEXs will be, you know, the key platform to work with.
Yeah. In terms of aggregators, for our experience at Balancer, we see that the majority of our trade actually comes from aggregators. It doesn't come from our UI, but it comes from them. However, there is a general, let's say, you know, users are very much used to use Uniswap in case of mainnet and probably here Trader Joe. So until, you know, we will reach a point where maybe, you know, the market share of the, you know, Uniswap or Trader Joe will start reducing. This is when aggregators will play an even more important role compared to today. So it's a little bit of a waiting game for aggregators to play at the moment. But certainly aggregators in the future will probably be the place to be, the place to go actually for any trade. So yeah, and this is why we, and together with 1inch, we have such a great relationship, and we are good friends, and we, you know, we're going to integrate, you know, they're going to integrate us actually in the future, so.
Amir?
Yeah, I agree. Like, I think that long run, like most trading volume done by humans, like is going to go through DEX aggregators, and I think aggregators are likely to, you know, end up capturing a lot of the value. But, you know, I think it will certainly be split amongst liquidity providers and aggregators as well. I think MetaMask is a really good example that, you know, shows how successful an aggregator could be once they grow their user base enough. You know, I think it's public knowledge that, you know, they probably made more money than like a lot of the major AMMs combined. And that's just, you know, because they have all the users, like 10, 20 million users or something like that. But yeah, I'm definitely biased, you know, building one of the major aggregators. I also think just, you know, in the long run, there are going to be so many different types of assets that, like, there will never be a one-size-fits-all liquidity solution that works for all their needs. I think different assets will have different market structures that work better for them. And I think it also plays into the bull case for aggregation.
Definitely. And then just in terms of what you're watching, what you're excited about in the DeFi space, what are your expectations for the next 12 months? I know that's a very long time in crypto, but bear with me.
I mean, we're starting to see some pretty interesting things in like the bridges and cross-chain space. I think sure we'll see a lot more experimentation with that over the next year, and that's one thing we're keeping an eye out for. There are, I don't know, probably 50 to 100 different bridges being built right now, and several of them are live, and I don't think a winner has really converged yet. So yeah, definitely keeping an eye on that.
I'm very excited about gamify elements that can be brought into DeFi, and this bot can, you know, certainly bring new users into space, educate them how to use these complex services, and show them how everything works on the back end, on the behind, on the smart contract level. And, you know, like, we need more friendly UIs so that, you know, our parents, our, you know, friends who are not familiar with crypto will be able to, you know, use those protocols and feel like this is comfortable, this is native. So gamify, I guess, together with DeFi can, you know, accelerate the adoption of this financial aspects of crypto. Yep.
Yeah, it's difficult to say exactly what is gonna be really exciting because this industry changes so fast. All of a sudden you have an NFT popping up left and right, and that becomes a new trend, right? So what I can tell you is that at Balancer we have a couple of grantees that are working on tokenized real estate. So they're trying to be like these indexes around real estate, and that sounds very interesting. I wouldn't say it's probably exciting, but certainly something that is interesting to see. Definitely the gamifications is another area that of course is going to probably bring the next wave of adoption. Generally speaking, also going back to the NFTs, what we're seeing is all these retail investors that have never been interested in crypto or in decentralized finance, that now they're kind of helped to come and participate into DeFi. So we will have a new wave of users that will start using all these applications that we are so bullish on. So that's probably that's what I see.
And then just in terms of regulation, I mean, what challenges does that pose to the space, or how might regulation change or influence what happens in DeFi? I know it varies country by country.
Well, as I said before, I mean, it's all still very much US-centric. So we're still all looking at what the US administration is doing. If I have to give my own opinion, personal opinion, not Balancer or anybody else, I think regulation, it won't come anytime soon, okay? The moment, if I have to guess, probably at the moment, for what I see is that the US government is struggling with other issues, probably, inflation and other things, and probably they're not enjoying the best time in terms of approval ratings in general. So probably this will, let's say, slow down a little bit, the implementation of new regulation for the crypto market. I might be wrong, but this is probably what I can see in the future.
We sincerely hope that the regulation will be smart, efficient, according to the market conditions. Everyone, I guess, can be affected if there will be like really harsh terms, and QIC would be imposed, and I don't know, some platforms might get blocked. Actually, at one point in time, when there were a lot of rumors about different regulations and stuff, a lot of platforms started restricting their services towards sanctioned countries and some countries unsanctioned, but which you would just want to make sure that nothing, non-users from those regions are getting harmed. And yeah, I think it would make everyone's lives easier if we knew the rules, and if the rules would be fair and efficient, and it will probably take a couple of more years till we see all of that.
Amir?
I'm not too worried about regulation as long as it's sensible. I think it could actually be good for the space and bring in more institutional players on both sides of the market. So hope that's the direction we're going in. Don't think it'll particularly slow down innovation. These are global markets from day one. It's, one of the major advantages. So yeah, we'll see what happens, but I'm optimistic.
Yeah, I think we can all agree that things are not happening very quickly, at least in terms of the US. I wanted to ask if anyone from the audience had any questions. We have just a couple minutes left. Okay. Well, thank you all so much. I really appreciate it, and I hope everyone enjoyed.
Yeah.
Thank you.
Thanks, everyone.